So you've heard that electric cars come with some great tax benefits, but some of the best ones are coming to an end, so you're going to need to act soon. Let me show you how it all works and what you need to do to get the best tax breaks. So watch on. So as always with these videos, I'm focusing on UK small businesses and their owners. Now I'm going to run you through, firstly, a reminder quickly on how cars work for tax for limited companies, sole traders or partnerships. Then we're going to go over why electric is pretty good for tax breaks in general. Then we'll go through the main tax breaks, including which ones are going away. We'll talk about VAT, can't not talk about that. And then towards the end, I'll give you some practical tips to use when you're choosing a car for business. So first then, let's recap. If you use an electric car in your business as a sole trader or a partnership, you've actually got two possible ways to deal with the costs. Now, we've done other deep dive videos on this, but I'm just going to give it back to you in brief. And if you're a limited company owner, still hang around for this because one of the parts is going to be particularly relevant for what I'm going to talk about to you in a minute. So then in brief, for a sole trader or partnership, generally you can deal with vehicle costs in two ways. You can claim mileage for business journeys at a fixed rate set by HMRC, or two, which is the one we're going to focus on now, is claim a percentage of the running costs and get some tax relief on the cost of the car via something known as capital allowances. Now with this option two, you've normally got to restrict or kind of disallow a percentage of any costs. If you're using the car privately, you've got to work that out and sort that out. But in this video, it's option two where the benefits are about to change, and it's where we're going to be concentrating. So if you were buying a new electric car in the past few years, you'd have very likely wanted to use this option two in this capital allowance route to get the maximum benefit. And that's because there is a way to write the entire cost of the car off against your tax bill in the year that you bought it, but only if you use these allowances. And for sole traders and partnerships, this was the key benefit of an electric car from a tax point of view. But for limited companies, it was a lot more interesting. With limited companies, when it comes to buying a car, there's a couple of areas of tax that are really key to consider. The first one is, what is the tax bill associated with the company buying that car and then giving you access to it? And then secondly, what tax relief is available on that purchase of the car for the company itself? And we've done deep dives on those as well, but I want to briefly recap it here. And again, if you're a sole trader or a partner, still hang around for the next few minutes because it's good to know how this is going to work if you ever wanted to do it, and it's going to lead into the bit that really affects you. So in brief then, when the limited company buys that car and it lets you use it as the employee and as the director, you're generally now going to be in receipt of what's known as a benefit in kind. And this is because with cars, except in very rare circumstances, they become available to be used privately. And HMRC's definition of what private is very wide. So if it's going to be sat in your driveway, it's almost always going to be deemed to be available to you personally. And if you think about it, commuting from your home to like a fixed place of work like your office, that's always going to be personal use as well. So where cars are concerned, you're normally going to end up with this private use benefit in kind charge issue. And it means that you as the director / employee will usually have a personal tax bill on the benefit, and then the company also gets a tax bill on providing the benefit to you. Now the way this value is calculated is that you take the list price of the car, so not what you bought it for, doesn't matter how old it is, and then you apply a percentage to that price, and it gives you a pound figure. So the percentage you use is based on the CO2 emissions of the car. So the kind of thing to think about is more fumes equals more tax. So if you took, say, an old diesel, you could be looking at up to 37% as that percentage that you apply to the list price for your benefit each year. And that is massive. So by way of example, if we took a £40,000 list price, it could be a £14,000 plus taxable benefit on you before you've even fueled it. And then if the company pays for the fuel, could be another 10k plus benefit. Those benefits combined can easily turn into a tax bill combined for you and the company of £8,000 plus. So for those reasons, you don't see many of those type of cars inside of a limited company. But electric's different. And that's because the benefit in kind for electric cars is far less. It's only a mere 3% at the time recording the video. So if we use that example again, a 40k list price is more like a tax bill in this instance of 240 quid for you and 180 for the business. So a massive difference versus a traditionally fueled car. On top of this, if you're charging it at your workplace, you're literally driving it to the office and plugging it in, it's actually a tax-free benefit. So you don't even have to worry about that fuel charge that you have on like a petrol or diesel vehicle. And there are other ways you can deal with those charging costs, but I'm just going to keep those for another video. Now I said some of the tax breaks were going to go away, and this benefit in kind is one of them. It's not going away, but it's certainly getting worse. So what's happening is the percentage we're talking about is going to get progressively worse over the next few tax years. So by the 29/30 tax year, you're actually going to be at 9% benefit in kind. Now for limited company owners, that's still reasonably okay. It's not disastrous when we compare it to say 30+% of a traditional full vehicle. And if we take into account that in order to buy the car personally, you would have had to have drawn the money out, and then all the repairs, the insurance, the running costs have to come out of the company for you to pay it. It's actually quite a lot of tax involved with that. Whereas if the company pays for it, it's still good. So 9%, not disastrous, but do know that it is going to start to get worse. However, that's not the bad news. The main break that's currently due to end, and it's the one that's going to affect you whether you're a sole trader, partnership or limited company, is this special capital allowances treatment, this first year allowance as it's known. And that's the thing that gives you 100% tax relief on the purchase of the vehicle. And the way it currently works is that when you buy a new unused electric, currently you've got the option to claim this first year allowance. And as we said, that lets you write off the entire purchase price in the year that you bought it. Now, bought it for tax purposes can get a little bit technical, so let's just say not leased. So for example, things like traditional hire purchase, bank loans, your own money or your company's own money, just use those things for an example. So let me show you how it works. So let's say you made $100,000 profit in your business, and let's say the tax bill was 25k. I'm just picking a 25% rate here just to keep the maths easy. If you bought a £40,000 new unused electric car, your profits are now only £60,000. So your tax bill is now only $15,000, saving you 10k in tax. That's pretty big. Of course, the downside is that you're spending 40k to save £10,000 worth of tax. So as always, with any business expense, you've got to be happy that that investment is going to be worth it for you and your business. I've said it a million times, but I don't like the idea of spending money just to save tax. It rarely plays out well. But if you're spending money you were going to spend anyway, making it as tax efficient as possible is definitely going to be a win. Now, I know with this particular one, there's many owners that just don't like the repair costs of electric. They don't like how much depreciation, how much the value of the car drops when you drive it off the forecourt, all that sort of thing. So it might be that electric's not for you, but if you're watching this video, I presume that you've got at least a passing interest in getting one. So you've just got to weigh it all up. Now, from a cash flow angle, kind of interesting, because if you're going to hand over £25,000 of tax to HMRC anyway, that £10,000 of tax that you now don't have to hand over might even fund the first year's loan repayments, for example. So it can have some other benefits. You've still got to fund it afterwards, of course, but that's a problem for another year. So after hearing this, and given the climate we're in, it probably won't surprise you to know that this is the tax relief that's going to end soon. It's actually ending on the 31st of March 2026 for companies and the 5th of April 2026 for sole traders and partnerships. So if you want to benefit for this one, do it soon. And this is mainly because a really important mistake here that happens in this situation is that people underestimate the fact you need to normally take delivery of the car before these end dates to be able to claim the allowances. Like all things tax, the criteria for these capital allowances are pretty detailed, but delivery is a key part of how the law works here, so just don't get caught out. Make sure you order it in enough time. If you do miss the deadline and you buy one after, you still get tax relief on the purchase price using allowances. It's just that it's not as good. The relief is spread out over time. At the time recording this video, for a new unused electric, you're looking at about 18% a year. Although the way it's calculated with this 18%, you still get more relief up front than you do in the later years, but it's nowhere near as good. Now, a couple of other important things you might want to know here. Firstly, we could not talk about VAT. Now, when buying a car that's going to be used privately, so it's going to be given to you as a limited company, director, employee, and it's going to be available privately, or if you're using it in your sole trader or partnership business and you're disallowing some of the costs because you have got some commuting, some private use, then VAT is just going to be blocked. It's a very common mistake because it's not very well worded. If you search it up, even on HMRC's website, kind of gives you the feeling that it might be recoverable, but for cars generally, it's not normally the case. There are rare instances where it is possible, and also when you're leasing, which we're not talking about in this video, then often you can claim about 50% of the VAT on the monthly bill that you'll see, but with a purchase like this, it's usually bad news. Now, I also think it's worth a word on vans, because when we're talking about electric, EV, vans is a new kind of emerging area for this, but vans in general, if we've got a vehicle that's actually a van for tax purposes, you might think, well, why are you wording it that way? Because oddly, it's quite arguable about what's a van or not, but let's just think in our head, traditional van, right, white panel van. They're actually treated pretty favourably by HMRC, and you're still likely going to be able to access 100% tax relief via capital allowances. It's just another allowance. It's called annual investment allowance. So vans are still pretty good. And then for limited company owners, that benefit in kind bill we're talking about also works out far cheaper for a van, but I'll leave that for another video. But let's just say that it's a fixed cost. It ignores emissions, so it's pretty tax efficient. Oh, and the other thing, VAT is often recoverable on a new van. So then I did say I would give you a few practical tips of the key things to look for from a tax point of view when you're going to go and buy that car for your small business. So for me, based on what we've just said, the first thing I would consider actually is, do I need a car or will a van do? Because for all the reasons I've just said, vans work out really well for tax. Just be careful if you're thinking of getting what is I think commonly called a crew cab in the tax world. We call it a double cab pickup, a crew cab pickup, because they're about to change. They're now going to be taxed as cars. They were obviously far too good as far as HMRC were concerned. So now they're going from a van, which had a very low benefit in kind and all those allowances we talked about, into a car. So watch for that one. But think about, is a van better than a car? And then if the answer is no, I definitely want a car, then then we're back to, can we do electric, and can we do it new and unused by the 31st of March 2026 or the 5th of April 26 if you're a sole trader or partnership? Because if we can, that's going to give us access to those first year allowances and the best tax result. And actually, even after those dates, it's still arguably going to give you one of the best tax results anyway, particularly if you're a limited company, because of the benefit in kind reasons we were talking about. And then regardless of the car, I'd be thinking about, is it better to buy or lease? Now, that's quite a wide question, but if we're looking for the best upfront tax relief, particularly before the deadline for these electrics, we're going to make sure we're going to need to buy it. And there's lots of different ways to fund a car, but some won't count as buying for tax purposes. Some of them can almost end up like a lease. Now, I can't give you an easy answer of how to spot that. So I'm just going to say to you, sadly, seek professional advice if you need it on those, for somebody to look over it and tell you whether it's going to count for capital allowances as being bought or not. Obviously, if you're using your own money or the company's money to buy it outright, you're not generally going to have a problem. But if there's finance involved, do get that checked. And if you really don't want electric, consider things like plug-in hybrids, but you want one with the maximum battery range. And in combo with that, of course, you're aiming for the lowest emissions possible. And the reason is that for a lot of the tax reliefs, emissions, as we said, is going to be key. And for limited company owners, the benefit in kind percentage that's applied to a hybrid is a combination of the emissions and the battery range. So currently, you can actually get some pretty solid petrol vehicles at about 12 to 14% benefit in kind, which isn't too shabby. And whether you're a limited company, sole trader or partner, having those low emissions is going to help you with the best tax relief on the cost of that car. So let's say you've missed the deadline, you're still going to get the tax relief over time for the car, but the CO2 emissions are going to determine at what rate. So at the time of recording this video, it could be that you only get 6% of the cost every year, and that takes a very long time to get full relief, or 18%, and the emissions is the thing that makes the difference. So at the time of recording the video, being under 50 GKM is an important threshold to watch for. And there you have it, some practical tips that hopefully will get you the most tax efficient result. But if you do have any questions, do drop them down in the comments below, and I'll do what I can to answer them. And if you're interested in vans, watch this one.